So I want to start off with the factors driving consolidation. The first is pretty obvious to anyone who runs an exchange, or for that matter, a broker-dealer. It's a scale business. When you have a fixed cost trade infrastructure, the more transactions you can put through it, the better your economies of scale. That's been a factor since the beginning, but especially as exchanges have demutualized and gone public, when they actually have to worry about their profitability and shareholders, that's made it a necessity of considering this. The second thing that's been a huge driver of the desire to consolidate is the amount of competition and the volume declines in some of the developed markets, in particular, that have faced fragmentation. The acquirers in general are seeking higher margin, less competitive products such as derivatives. And then there's a third factor, which is just people being some of the big exchanges being afraid of being left without a dance partner, asset scarcity. NASDAQ, I think, in particularly felt that back in 2011, when NYX and Deutsche Börse had proposed this big global merger. What were they going to do? Where were they going to be left in terms of competing and delivering synergies to shareholders that they'd become accustomed to? So this is just one example, although I could use many. This just shows U.S. equity volume declines since the 2008 crisis. There's been some occasional spikes of volatility that have driven up volumes, but for the most part, we've seen a downward trend, which I just mentioned during the last session. You could also look at other asset classes. You can look at, let's say, the CME and look at interest rate futures volumes. While they've come back quite a bit, still we did a paper, looked at the quantitative drivers of interest rate futures volumes, and what we found is that securitization was the #1 driver. As most of you know, the securitization market in the U.S. Really got clobbered during the crisis and is a shell of what it used to be. So with that being a big driver, it's hard for interest rate futures volumes to come back, even with raised interest rates, which people often talk about as a driver of volumes. Our research shows that they won't come back to the same degree they had before. So these developed markets are facing a challenge on the volume front. They're also facing a challenge on the competition front. This just looks at, I'm not going to go through it in detail, but just by looking at the colors, the many different colors that are added in the 2012 slide or graph on the right versus the 2006 slide, you see a lot more colors and a lot smaller slices. That's the U.S. experience with fragmentation. So these markets that are not growing from a trading perspective as a whole are also the big operators are getting clobbered by new combatants. And you see not quite the same degree of decimation, but you still see over the past few years, this is the FTSE 100 order book market share, LSE, the big red element of it, losing about 13 percentage points or so. The CAC 40 in France, 10+%. The DAX in Germany has held up better, down 6 or so percentage points. But new competitors are coming in. That makes it much tougher on these developed market operators. I started to get into this slide a little bit in the remarks on the last panel, but this is just something. We cover the exchange space from a market structure perspective, a regulatory perspective, but we also do it for investors. And one of the things that, as exchanges were announcing mergers a year plus ago, people would ask us, well, who's next? Who's going to acquire who? That was the popular question. So I tried to think of a little bit of a framework, and I came up with this 3-bucket framework. And basically, in my view, you have more or less 3 categories of exchanges when we think about them from an investment standpoint and the big operators. You have the first category, which are folks like BMF-Bovespa, Bolsa Mexicana, Hong Kong. They have home country market growth. The truth is, M&A is a bit of a distraction for them. They really need to concentrate on, 1, preserving the monopoly that they have, 2, attracting more order flow, putting out new product, ETFs. That's where the growth is going to come from, because if your economy's growing 5–10% plus a year, you're going to have nice growth. You're going to be, if you're a public company like Hong Kong, you're going to be able to deliver that growth to your investors. You have to figure out China, how you're going to continue to stay competitive there as those capital markets mature. You don't really want to be distracted by large-scale M&A, frankly. And I would put the CBOE a little bit in this category because they have some protected product, and options, I believe, is still a growing asset class. So, but some of their markets, they're competitively listed products. They're not quite in category 1, but that's sort of where they are. So they're in a place where M&A is not only not necessary, in some ways a big distraction. Category 2, I'd put exchanges like CME, ICE, Deutsche Börse, and NYX. They have a good set of assets. They have exposure to derivatives, but they don't have much home country growth. So they're looking for exposure to the emerging markets. They're looking for exposure to the right asset classes. So someone like an ICE really tries to do that through the exposure to commodities, which is driven by South Asia and East Asia. Someone like CME has really done the work with the Globex platform, trying to do deals or actually doing deals with places like India, Mexico, Brazil. These are folks that don't need to do M&A, but they'd like to if they could. They have shareholders. They want to deliver returns. They're not going to get it from their home country growth. They'd like to do deals with emerging market players. They may do it through alliances, through distribution arrangements, and if they could do a deal at the right price, they'd like to do it. So you'll see these players pursue M&A, or at least you were seeing them. Now, maybe a bit gun-shy to try to do a big global deal, but these are the types of players that will go after an asset like the LME because it's in the right asset class for them, and they do want to deliver synergies. They can electronify a platform that's not fully electronified. They can provide further distribution. So that's category 2. And category 3 is the bucket where there are folks that are, these are folks that are in very competitive markets. They tend to be exposed mostly to equities. This is the LSE, NASDAQ, TMX. You saw all of these players very much pursuing M&A because the obvious thing they could deliver to shareholders is synergies. And again, it's a scale game, so that's something they pursue. They will look, some of them will look to move up market. I think LSE is actually strategically doing a nice job with that, trying to get some more clearing assets in-house, trying to do more in the index business, because if they're left to fight over the scraps in the equities markets, it's a tough road for them. So that's, I don't know if that helps at all, but I wanted to kind of lay out how we thought of it. So let's take a look at the deals that happened and didn't happen. The blockbuster deals, as we all know, failed, but intra-country M&A, alliances, and sort of bolt-on acquisitions are alive and well. So I did this on an Apple, so I decided to send the PDF to make sure it worked. But in PowerPoint, I would have had each of these come up individually and X them out and everything. But this will give you the sense of what happened, what we all know. SGX and ASX sort of started all this with a big announcement. Obviously, eventually failed. LSE, TMX failed. Deutsche Börse, NYSE, Euronext failed. And NASDAQ and ICE even tried to intervene and tried to break that up themselves. We still have TMX Maple on everyone's plate, but whether that'll happen or not is a real big question mark. Then we, look at some deals that actually succeeded. Now we talked about, a couple have been talked about already, MySix RTS, BATS Chi-X, but we also have, as I mentioned, a couple of London ones. London in the process of doing LCH ClearNet, buying the other half of the FTSE. We had an in-country merger of some of the Argentinian futures exchanges. And then we have Tokyo, Osaka still pending. And we have a lot of tech deals happening. NASDAQ, F10, NYSE, Euronext, Fixnetics. These deals got across the goal line, and they're niche acquisitions, and I think we're going to see more of that. So let's just take a moment to look at why the mega deals are failing. The first reason some of them failed was antitrust and other regulatory concerns. In the EU, looking at the Deutsche Börse NYX merger, the Competition Bureau took a very narrow view of derivatives competition, excluding international competition, excluding the over-the-counter market. And once you do that, it was going to be a tough road for DB1 and NYX to get across the goal line, and ultimately it did fail. And you had, at the same time this antitrust review was happening, you had a lot of regulatory things happening, looking at interoperability, looking at breaking up vertical silos. So that put sort of a political pressure on things as well. In the US, when NASDAQ and ICE made this counter bid for the NYSE, the US Department of Justice, actually, in our opinion, wrongly, I would also say I don't agree with the EU's decision on this either with DB1 NYX, but in the US, I think they wrongly decided that the consolidation of listings venues would be anti-competitive, and even on some of the trading stuff, they talked about that being a big concern. And I think the US market is so competitive and so fragmented that any consolidation is not going to hurt the competitive environment, being completely frank. You also saw in Canada, the Competition Bureau still has concerns about a combined Maple TMX, particularly with the post-trade clearing infrastructure supposed to be combined in that deal. Also Alpha, which is the broker-dealer consortium, would be combined. So whether that gets done or not is still unclear, but certainly antitrust was a big reason these mega mergers failed. The other one is you have nationalism and dealer backlash. In the case of the Australian rejection of SGX, that clearly was the reason. And then when you had the LSE TMX deal, which ultimately did not happen, the Canadian dealers on the whole were fighting that. They had a sort of an oligopoly in that market, and internationalizing that market wasn't something they particularly desired. But these major M&A drivers that we did on the first slide are not going away. I'm not going to go through them again. They're still here. M&A can still thrive in this environment. It's just a different type of M&A. Intra-country consolidation, which we already went through. Countries do want to encourage national champions for those that aren't public companies. Certainly as public companies in some of these markets, there's a desire for the scale advantages we talked about. And I think following the flash crash in the US, there is a strong anti-fragmentation bias of some of the regulators and politicians in these markets. I think they've bought into the arguments of the monopolies that would say something to the effect, in most cases, most of the markets would say, HFT isn't that bad of a thing, let those guys in, just don't let competing market centers in. That's where the problem gets created. And I think there's been a fair amount of adoption of that viewpoint in some of these other market centers. So I think intra-country deals can still happen. They are still happening. They can bring cash and derivatives market under one roof, bring scale and synergies that can be delivered to the user base. Smaller focused deals and stakes and bolt-on acquisitions are also happening. Batch Europe and Chi-X is certainly an example of that. And maybe I'll take a moment here to address some of the things I was supposed to talk about on the user end. I think people mistake, when the US and Europe were announcing consolidation, people would say, oh, well, that's going to lead to less fragmentation. You're going to take two companies and combine it into one. But there's a big difference between platform consolidation and actual market centers going away. So in the case of Batch Chi-X Europe, it's expected that they will continue to run two different markets. There are advantages to that. In the US and in Europe now, you see multiple market centers run by the same exchange group. Why? They can segment the customer base. They can offer maker-taker pricing in one that's very HFT friendly. In another market, they can have cheap take fees that are very advantageous to the broker-dealer community. They can experiment. So even in the case of Batch Chi-X Europe, where something it did get across the goal line, we have a deal, we're not actually going to see a reduction in the number of venues that are out there. And that would have been true in the US as well. NASDAQ said it wasn't even going to shut the NYSE floor. There is, I mean, part of that was politics, but part of it was real. Anyone in the developed markets, I think even in the case of Osaka and Tokyo, if that deal ends up closing, I wouldn't be surprised to combat Chi-X Japan if they ended up keeping 2 market centers. So very big difference between platform consolidation and actual removal of venues. I do think overall, and maybe we'll get into it in the Q&A, but I do think that overall these deals have advantages to the user base at the end of the day in terms of ease of interacting. One platform does mean, even if they have 2 different market centers, would mean one set of writing of code, one set of access points, and importantly, some of the cost synergies, I believe, would be delivered to the shareholders. How much, I think in an era of publicly traded exchanges is another story, but I do think overall that the benefits in terms of the synergies that the users would actually see would have outweighed any risk of decreased competition, because again, I think these markets are very competitive, the developed world at least. So I already went through a bunch of other deals in terms of controlling index product, whether that's Deutsche Börse and stocks or LSE and the FTSE, but lots of tech acquisitions. NASDAQ not only did F10, but also Smarts. NYX did Metabit, in addition to the Fixnetic stakes. TMX has done a bunch of small deals, Atrium, Razor Risk, all in the technology area. You're going to continue to see that. And again, bigger deals that don't have meaningful overlap or decent-sized deals like LME, they're obviously going to happen. That is an asset that is definitely hot. You know, the people I mentioned on that bucketing slide, there's a bunch of them going after this asset because they do need the growth and they do need to deliver synergies to shareholders. Alliances and JVs is an alternative to M&A in the developed world. Folks are certainly looking to bolster the growth, and now that they've been embarrassed by not getting some big deals across the goal line, they're not necessarily looking to do big cross-border M&A, but they would like to bolster that growth through distribution arrangements and such. Emerging market bourses are also trying to broaden distribution. In some cases, as I mentioned, it really would be more of a distraction to do M&A, and if they're publicly traded, it would probably dilute their multiples. So they're looking still at partnering with the developed exchanges, but as I mentioned, they're also working together. The BRICS countries are working on their own index product creation and distribution. Certainly other examples are out there in terms of the CME and Globex. An interesting one on the, more on the back office side of things. Deutsche Börse has worked with a bunch of firms, Cetip, Johannesburg, and the ASX through its Clearstream unit to work on collateral management. It's also done deals in Asia, also owns stakes in places like Bombay Stock Exchange, but it's done a partnership with the Korean Exchange and Kospi Trading. CBOE working to extend its VIX franchise into other markets. Examples are on this slide. And then even within region, we just in this last panel talked about how Turkey was pursuing that, but in Latin America you see the MILA arrangement. Another big driver of the M&A, but something that is going to continue to be a big theme, whether there's M&A or not, is capital efficiency. And we just talked about on the last panel, in the example of NYPC and US Life was given. This is important. Major banks in the world are trying to conserve capital in the post-crisis world. You've got Basel III capital requirements, you've got Dodd-Frank and other regulatory requirements that are pushing for more margin, so capital efficiency is huge. And exchanges that are focused on that and that can deliver that are going to have a huge edge. Example of in the DB1 NYX deal, clearly that was a huge driver. I believe originally they talked about delivering $3 billion of margin back to the customer base. Eventually that rose to a $4 billion number. It certainly is a huge factor behind the LSE LCH deal in terms of potentially allowing them to compete in derivatives, because as other folks mentioned on panels, it's going to be tough for them to succeed there, but this capital efficiency can be a real edge for them. And one of the best examples is BM&F Bovespa. While they did merge two exchanges a few years back, they still have 4 clearinghouses, and they are, that's one of the top projects on their list is consolidating those clearinghouses. So capital efficiencies, I think, is going to continue to be a driver of M&A, but more importantly, it's going to exist independent of any mergers and acquisition activity. And you even saw, I think a week or two ago, I just put this on this slide, CME announced some portfolio margining of interest rate swaps versus futures. So, margining between the OTC side of things and the listed futures. The last thing I wanted to mention, just to give sense of people of, well, what, besides working on all these deals, how are some of the big developed world exchanges looking at the world? I think they're, maybe the right word is not embracing the new reality, but they're accepting the new reality. Transformational M&A is going to be a huge challenge. The only way you're going to be able to do something of decent size like an LME is if you pay through the nose. It's going to be expensive because there's competition. So I think there's a recognition, if you follow these exchanges as an investment opportunity, that they're returning to the low to medium type growth profile of a utility, with significant upside when there's volatility spikes or new product developments, but you're not looking at the same type of growth rates that we had as markets were transforming. And if they can't do large-scale M&A, they've got to do something with the money they make, because they do make nice money. So you're looking at, like utilities offer high dividends, you're looking at significant dividend programs, you're looking at significant repurchase programs being instituted. And this will serve as a complement to alliances, as well as some of the more focused and smaller M&A opportunities. Below the text here just gave some examples of what some of the major exchanges in the developed world are doing, and you see they all have, CBOE is smaller than some of the other ones, so their program is only a 100 million buyback, but these other ones are several hundred million type buybacks, and the dividends are being increased across the board. You're also seeing special dividends and the institution of annual variable dividends, and the dividend yields of these exchanges are starting to be, really competitive with some of the other companies out there. So there's this, some of them, like an ICE, are a bit growthier than the others, so they're not doing a dividend at this point, but even they are being faced with that question at every analyst presentation. Are you going to, institute a dividend? When? How will you look at it? So it's sort of, without large-scale M&A, this is something I think that the exchanges are really focused on, those capital returns to shareholders. But that's about it.
Thank you, Joe. Are there any questions? So I've got a couple. One is, do these, some of these M&A programs actually make sense? Because I put up some slides last year based on some data from Thomson Reuters where essentially exchange mergers had destroyed shareholder value relative to other equities.
Yeah.
Now, if you look at, say, 2 of the deals that are still on the table, the LME deal, the reported price is in excess of $1 billion, profits 11 million. How does a listed company buy such a company with such strange numbers that can't support the price? And similarly, on the LSE LCH deal that's going through at the moment, with what Fraser said, they're going to lose the derivatives clearing, so they'll only be left with LME as a derivatives clearing. And on the cash side, now, for example, XClear has in excess of 20% of the market, EMCF has an even larger percentage. What is the economics behind even the remaining deals that are on the table?
Sure. Well, let me hit the bigger point first, and then we could talk about some of the specific deals. Firstly, I would say that, on some of these deals, you've seen the mega deals, you saw a lot of talk about revenue synergies, and I'm a big skeptic there. Okay, yeah. But I am a believer in the cost synergy side of it, and the capital efficiency side of it. So I do believe that most of these deals actually did make some sense. I think, you know, it's a little hard to separate out when you look at some of these deals. You know, the exchange space has gone through quite a whirlwind over the years. You know, growth companies, then they're value companies. You know, it's a lot of other things happen in the interim with volumes and other things. So I think ultimately time will tell in the shareholder value, but I do believe that, you know, we are talking hundreds of millions of dollars of synergies on some of these big deals. So I think that they can be delivered when you combine platforms, when you combine, to some extent, you know, reduced staff, sales force, et cetera. So I think you can deliver shareholder value. Now, as to these examples that you cite, clearly, in the case, let's start with LCH. Clearly, if they end up losing NYSE Euronext entirely, which, look, there was a, you know, at a conference the other day at FIA, they were again sort of out there, well, we're going to do what we can to keep them, and they're out there, you know, offering olive branches and trying to do something. Now, clearly, NYX has a newfound working relationship with Deutsche Börse and Clearstream, so there potentially could be something there. There potentially could be something they build themselves. So when you look at the current revenues, it's a tremendous part of their revenue. So it will be a real challenge. So the justification for something like LCH has to come from future growth opportunities. It has to come from Rollet is betting that on the derivatives front, this is what he needs to really get into the derivatives space. This is, you know, if you look at his pattern, you look at the acquisition of Turquoise. Well, he left half of it in the dealer's hands so they could participate. He's doing the same with LCH. He's intending to buy 60% of it to give the dealers some exposure. So hopefully, and you know, we're a big believer in that remutualization theme. So I think that's Rollet's play. Whether it pans out or not, I can't really say. But that's the only justification for paying that kind of price, and it's the only way. Also, you had to pay that kind of price to get the dealers to let go, because right now they're pretty happy paying very little for swap clear. It's a utility priced model, all you can eat type model. So they don't really want that to change. So they needed a decent price tag for that. And then with LME, I think it's actually a great asset. And in fact, you know, before we actually started our banking effort officially 3 years ago, I had, you know, found some people wanting to sell stakes, and I was out there just sort of as a side thing saying, hey, someone should buy these stakes from us, because I was like, this is one of the only assets out there that hasn't been fully electronified. It hasn't really embraced the future. It doesn't have its own clearing yet. So again, another risk in the LCH deal. Will LME stay with it? You know, depending on who buys it, probably not over the long term. So I think it's a really good asset. The issue is when you have people like ICE and CME and NYX and others who would like to have it, you're going to drive the price up. I do think you can't when you look at a company that isn't a public company, hasn't had the discipline to do that, has been run for the dealers as opposed to for the shareholders, I think you can't look at it the same way. Because now, again, that means the price has to be high for the dealers to let go, because they have a nice little club going, and do they really want their prices raised? So it's a tricky thing, but again, when someone pays that whatever price tag they pay, they're going to have to be comfortable. I know they're going to be comfortable that they can deliver synergies, that they're going to bring in a platform that will result in more volume and save a lot of money. Then, you know, will they be, you know, how are they negotiating with the dealers to make sure that they can, at the end of the day, run this as a profitable exchange? A lot of question marks, though. It's a real risk.
Okay. Anyone else? Okay then, thank you very much.
Thanks, Brian.